Good afternoon, everyone, and Happy New Year. It is 2025, and you're ready for some great education. We are going to get started with this options replay webinar. It's been a very popular presentation where we highlight options trades and see what works and what doesn't work. So we titled this presentation Options Replay, Strategizing Your Options Trades. We look at, a week before or 2 weeks before the session and try to find different spots where an options trading strategy would have made sense and what the result would have been. If it didn't work, try to explain the reasons why it didn't work. And if it did work, just to emphasize the reasons why it did work. So it's a great opportunity for us to take trades and look at the practical sense of these trades, and it's a great learning experience for everyone, for those that are new to trading and for those that haven't traded complex option strategies. I think it's a great way to learn. So let's go ahead and get started. As usual, our guest speaker is Brandon Wendell. He's a recurring guest speaker for TradeStation. He's not affiliated with TradeStation, although we love having him because he's an educator, he's a trader, and we benefit from all his expertise. Brandon is going to join us in a moment. I'll pass the microphone over to him in just a bit. I just see that he joined the room. For those that don't know me, my name is Jesus Nava. I'm the Director of Client Training and Education for TradeStation Securities. So we want to make sure that everyone here has all the educational resources that are needed for you to support your trading journey. Let's go through some of the disclosures before we continue. Keep in mind that every symbol and idea that we talk about is for educational purposes only. That these are not recommendations of TradeStation, and also that active trading is not suitable for everyone. It has risks, especially when you trade options, they have a little bit of a higher risk profile. Just be aware that any performance results is no guarantee of future performance. So just make sure that you keep that in mind. If anybody needs additional information on the disclosures, go to www.tradestation.com/important-information. And a little bit about what we're doing here at TradeStation. Let me just pull up my TradeStation website here for just a moment. If you visit TradeStation.com and you go to the top menu and hover over Learn, you're going to see Options Education in there. That's where we house all the articles and all the webinars and all the short form videos that we create on options trading. If you haven't been to the Options Education Center, please do so after this webinar so that you can explore all the different topics that we've created for you. If I go here to the Options Education Center, this is also the place where you're going to find an archive or a recording of this presentation. If I scroll down on the Options Education Center, of course, you're going to see the Options Strategies section first, but right under it, you see the Options Replay banner. You can register. Of course, everybody that's attended right now has registered for this webinar already, and I believe it automatically registers for upcoming webinars as well. But if you wanted to see a prior presentation, just click on Watch Previous, and we have uploaded the previous presentations here, with the most recent one being the bigger box. So if you scroll down, you see older ones. The one today is going to take us a few days to post, so just give us a little bit of patience. But by maybe Wednesday or Thursday, come back here and you should see the recording of today's presentation. Let me go ahead and switch over my presentation to Brandon. Brandon, I see that you logged in. How you doing today?
I'm great. Yeah, just shoveling myself out from about 8 inches of snow.
Awesome. That's great. But it was cold here in Texas, but not as cold as having snow, but it must be beautiful out there.
Yeah, it looks beautiful, so I don't mind. It's a lot of fun.
All right, guys, enough of the introductions. Let me pass the microphone over to Brandon. Brandon, the floor is all yours, and I'll be here just in case you need me, okay?
All right, appreciate it. Thank you. Yeah, welcome everybody. I'll go ahead and share my desktop in just a moment here. And oops, got the wrong buttons. Sorry, I just had to switch computers, so it's always that fun little bit at the last second there. But let me go ahead and I'll share my desktop with you guys. Just a quick introduction for me, wondering who the heck I am if you haven't been here with us before. I am a full-time trader and also mentor for traders. do education, and basically I've been doing this for over 25 years. Got started off in the brokerage industry. I was actually a retail broker for a little bit and didn't really care for it too much, so I ended up moving into back office operations. And in the back office, I was a trader for the brokerage, which basically means I held or handled order flow both for institutional customers and retail customers. So it was a bit of an education there. I got to see how markets move based on order flow. And that's pretty much what I do when it comes to my trading. I still trade based on that order flow. So I'm an independent contractor, and TradeStation has come in and asked me to help with you guys because I'm very familiar with the platform as well as trading to kind of go through kind of a bit of a post mortem, if you will, on some of the trades. And what I actually want to go here to the apps. We're going to today bring up Option Station Pro and talk a little bit about some of the trades we've already had open and are still, well, we can't do anything about it right this moment because the market's just closed, but we can still monitor and manage them and kind of talk over the why and when it's applicable. Now, the strategies I'm going to be focusing on for today are talked about in the options education center. So if I go out to tradestation.com right here under options education, I'm going to be talking about straddles and strangles. And in that options education page, if you need more information about the strategies themselves, this is where you'll find them. So right there, you've got Strangles, options, your tool for unpredictable markets. And if you scroll all the way to the right, the very first one that was created here is straddle opportunities for earnings. And this is kind of apropos for right now as well, because we're coming into earnings season. And straddles and strangles, as you can see by the risk profile, are applicable for when you don't know which direction the markets are going to move, but you're expecting a very large move. Now, there is always risk involved, of course, because if prices don't move, then you're stuck in that red zone on the risk profile. And that's where you lose profits or lose money, I should say, not profits, you lose money. Same thing with the strangle. There it is. Notice there's a wider red area. Okay, so there is possibility of loss when it comes to these strategies, but they are applicable for when we're expecting large price movements. We're just not sure which direction. If we know the direction or have a higher probability of the direction, we can simply play one direction or the other. So going into Option Station Pro under Manage, you'll see that I have this one position that looks pretty good here, AXON, and that is a straddle, and that was placed. It's actually expiring very soon, so I have to make a decision on what I want to do with this, and probably should have already exited, and we'll talk about that as well. So again, the details of the strategies themselves are in those in the Option Education Center. If you click there, you'll see, for instance, Strangle. It's the same for straddle. You'll find a video, article, and even webinar. There was a webinar from the Options Education Center. Matt Cashman, I'm sorry, not Options Education, OIC, he actually demonstrated a lot about that and did a webinar for TradeStation. So anyway, you can explore the strategy a little bit more. You got the angle, the article, the video, and whatnot. But what I want to do here is kind of talk about the straddle and or the strangle. If I go down to SMAR, there's an open strangle there. Okay. Now, these are past positions that were put on a while ago for the entries. This is not a recommendation to do with these strategies currently, okay? Because that's not what I'm doing here. I'm looking back to see how they were placed, why they were placed, and how you can manage those types of positions in TradeStation and Option Station Pro. So starting off, well, I'll start off with the straddle right here is alphabetical order. I also think I have one right here. Yes. So we have a positive straddle, a negative straddle as far as profits, and then a negative strangle right now. So we'll examine those. First, AXON, the straddle. If I go back to TradeStation here, I'm actually going to open up a new workspace. And by the way, when you go into the Options Education Center, one of the things you can also download are these workspaces. So for straddles for earnings, there's a workspace, and strangles, there's also a workspace. And the neat thing about those workspaces is that they have certain filters on the radar screen that can help you identify potential setups to use for that particular strategy. Now, they're not guaranteed. Obviously, you have to do some analysis on your own to figure out if it really is truly correct and right for you. But for instance, if we're looking for something that has earnings within the next 25 to 35 days, just on the S&P 500, I have 4 candidates now: Veritex, Uber, Omicron, and Hershey. So there may be an opportunity coming up. I say maybe because there's more analysis needed, but I can change some of these criteria. Actually, change this to 10 days, and that opens it up a little bit more. We have a few more securities: Alphabet, Whirlpool, and so on. So speaking of the security I was looking at, I wanted to go back, and I'm going to bring up under apps the trade manager. And the reason why I'm bringing that up is to go back and see, when was this position opened. So I'm going to go to my account, the simulated account, and we're going to start off with AXON for the security to filter for. And this was opened, I believe, back in October. So I'll just go October 6th to today. And all right, let me just go ahead and take this back off. Retrieve orders again, requesting history. And of course, I didn't change the, oh no, I did 1 year. So I'll be able to find it, hopefully, anyway, just by doing a search. So I know it was approximately October. And it's going in descending order here.
I think you can apply the symbol filter once you've loaded the history.
Oh, maybe. Okay. There it is. Thank you very much. And there's actually one more thing I need to do, because everybody's probably squinting really hard right now. So I'll go ahead and change the font for the displayed values and for the headers. And that's a little bit better. And there we go. You're right. Yeah, once I downloaded the data, now I can actually sort it. But one of the things is, if you try to sort it without choosing the actual account, it won't let you do it if you're going with this individual symbol. So I knew it was here, and there it is. It was actually the 7th of October, and opened up a straddle, and I ended up closing one of them, but I don't know why it's not showing, because I think I only have one. But let me just make sure. I go back to my open position right now. AXON, long one. Yep, and long one. I'm long a call, long a put. And the strike price on these is 117. You can see 25. I'm sorry, no, but it's 420. Sorry, it's the year, month, day, call, or put. That's how the symbols work at TradeStation. Then it gives you the strike price. So the strike price is $420. And basically, as you see, I entered this back on the 7th of October, and it shows both were filled. It's really weird because it shows 2 different positions, but only one that I currently have. So whatever. Anyway, I know this is when it was actually entered. And the reason why it was entered, if we go back to the 7th, let me go back to a chart here and just bring up AXON. And I am on the daily. You can see why I would want to enter it based on that gap there. But actually, what I need to do is bring in add study. And well, I don't need the next earnings date necessarily. I want to show the earnings dates that had already happened. Oops, and it's under show me, I believe. EPS postings. There we go. So this is just for looking back, obviously. Going forward, I would use the indicator next earning date. But to look back, just for our purposes, you can see I already kind of knew where the earnings were anyway because of the gap. And that's one of the reasons why I selected this particular security. Notice going back, there's another earnings and another huge gap. Going back again, another earnings and a gap. By the way, the EPS is posted the day after the earnings are released. So the earnings are released the evening of the candle before the gap. The indicator does the show me once the earnings are released on the open of the next candle. Not that it matters too much, but just so you know, that's why they're here. And you can see the big movements that we're getting. Now, one of the other things that you might notice is what's happening with volatility. Volatility spikes and then completely collapses after the earnings. Volatility is also known as investor fear gauge. Investors fear what they don't know. And what they don't know is if earnings are going to be good or bad. They don't know if there's going to be a small or a large move. They don't know if it's going to be up or down. So with this particular strategy, and you'll see it when you go to Straddles for earnings, we are typically looking for implied volatility that's lower than the average. And the reason why is we want it to be relatively low because you want to buy inexpensive options where the earnings coming up as the closer you get to earnings, the higher the volatility goes because people become nervous and unsure of what's going to happen. Option values will typically go up, the premiums, because people who are selling those options want to be compensated for the additional risk that they are taking on by selling into the unknown, the earnings release. So this was entered on October 7th. So let me go to that date, kind of set up the scenario here for you. There we go. October 7th. The earnings date, by the way, as I bring in drawing tools here, do a vertical line. Earnings were being released on November 7th. As you can see, well, may not be able to see it too well, but it's there, November 7th. And then, as I was saying, this was entered October 7th. So what was the situation on that day? Going back, take a look at the volatility. This is implied volatility, all options. That's what this indicator is. It's just an indicator that's on TradeStation as a normal indicator. And you can see that implied volatility is a little bit higher than the average at the time, but look at where it is in comparison to where it usually goes for earnings. Again, the closer you get to earnings, I'll shrink this down a little more and go back. You want to see that pattern where the implied volatility increases dramatically leading up to the earnings. And you want to enter this when the implied volatility is relatively low. Can I plot the cumulative theta decay versus the premium paid? No, I don't think I can, honestly. Yeah, I mean, I can do it on an upcoming one, but not on the current position that I have. If I go back to my positions here, again, if I go to AXON and analyze duplicate, there it is, AXON. You get rid of the others that are sitting here for some reason. There we go. And this is the straddle right here. So this is the theoretical P&L. And as you can see, this was a 420 strike that I did for the straddle. However, the current price is now 570. So it's obviously in a lot of profit. And if we take a look at the time decay, and this is, let's see, yeah, showing now 10 days and then zero. Well, I'm sorry, it's not now showing. Yeah, it is showing now 10 days till expiration, 5 days expiration, 0 expiration. It's not quite as useful, really, kind of showing you the theta decay versus the premium paid. I can't really chart it this way on this platform that I'm aware of. So anyway, really what it comes down to is, again, when I got into the position to show what I paid, should. Well, it depends on which one we believe was my entry, but they're both very similar. Filled price 64.70 or 51. And I could probably figure out exactly what it was based on what the current price is. I'm not sure which one it was actually filled. Current price and current value. Theta loss may exceed what you gain in the rise in implied volatility. Not necessarily. Okay. The reason why I chose this, and there's a reason why I chose the January options. I'm very late in exiting this right now, but I wanted to continue having this and showing you what does happen if you hold too long. When we look at this right now, it shows me, well, it's not showing my data, theta or anything like that here. But if I go to options, AXON, here we are, and the current options, well, 420 is going to be pretty far away. But even right here at the money options right now, you can see that my time decay is pretty high. My Vega is relatively low in comparison to my theta, isn't it? So what Chris is saying is that the theta loss, the decay in time is going to eat away what I'm going to gain in volatility. But it won't if I do this on long-term options. That's why I go further out. Remember, this was done in October with January expiration. So I had October, November, December, and January. I had 4 months basically until expiration. I don't have a similar position right now, closed right here with the 74 days. So looking at the money options at that time, right now, time decay 39 cents, $1.01 for Vega. So that's where this is becoming more advantageous because I do this with a much longer term horizon. Basically, I want to have at least 30 days until expiration when I'm exiting the position. If you don't do that, you're correct. That time value is going to be greater, or time decay is going to be greater than the value you'll gain from the Vega. But taking a look at the actual position again, going back to the chart, we had volatility somewhere around 30%. And you can see it historically goes about a month before expiration around 30%. Month before expiration, right around 30, 40%. And just historically, that's what it does. It opens up about a month before the not expiration, the earnings event, about 30% or 40%, somewhere in there. But it spikes up to 70%. So we're expecting anywhere from a 30 to 40% jump in volatility with a much higher vega compared to our theta, as long as we pick options that are expiring roughly 120 days out, if possible. At the very least, 90 days out. That gives us 30 days going into the announcement. If we exit right after the announcement, before the volatility drops, sometimes you can actually enter before the earnings, because this game can be very good even before the delta takes over with the big move. The problem is, I'm actually not worried too much about the gain necessarily from the volatility, because as you can see, if you get in roughly 1 month before the earnings, the volatility goes back to where it was. It could go a little lower, but it often goes immediately right back to where the volatility was when you entered. Let's take a look at what actually happened with this position. Zoom in a little more and move over to it. Right here, you can see that the volatility was approximately 33%, right? So again, I expected to go up somewhere close to 70. So I'm expecting about a 40% gain in implied volatility. That might be enough for my payday, especially because this also moved in price. So I had the delta moving up and I had the volatility moving up, both paying on the call side and actually saving a little bit of the weakness on the put side that's losing because it's going deeper out of the money. So what happens? Just before the earnings are released, right here, you can see, yes, this is recorded and there will be replays. There will be absolutely, there's replays available. Okay. So basically we get this huge gain, and it did. It actually went all the way up in volatility to about, and I forgot, I should have taken a picture at the time when this was at this level, but we went to 72. So we got almost a 40% increase in that volatility. And then of course, after the earnings release, where did it come down to? Again, 34%. Where did I enter? 33%. It's right back to where it was. But what was different? The price had moved from $420, where I was roughly at the money with those options, all the way up to about 600 bucks. So if the volatility went up and right back down and didn't do anything for me, I profited from the delta of the position because the call went in the money, deeply in the money, by about $180 in this case. Meanwhile, the theta decay was limited to about 30 days. And because I'm buying those options that are deeper in time, further out in time, you can see that the theta is very, very small in relationship to the premium. Now, these will cost you more, and you do have to be careful that there aren't some spikes in volatility. Let's see what else. Longer dated options on a spike. Yeah, exactly. We want to make sure that we have relatively low volatility. So that way, if the Vega is not necessarily where I'm trying to make my money, because when the earnings come out, the volatility will likely come right back. I want to make sure I don't overpay on volatility, because if it drops below where I entered, that's cutting into my profits from the price movement, the delta, right? So it's very crucial that when I'm planning this out, for instance, if I go back to my Straddles for earnings and I start looking at these Veritex, okay, we got 28 days until the earnings announcement, right? I have to analyze the volatility and make sure that it is relatively low in comparison to where it normally goes for earnings. This is probably not a good candidate because we had a big gap and a spike in the volatility recently. Maybe it's dropped back down. You can see that's implied volatility, all options down at 24%. Looking back at previous, what do we have here? Previous earnings releases, 22%. Previous earnings, 27%. I'm sorry, that was the average, 34%. On other earnings right here, that was actually at 43%. Okay. And this wasn't earnings. I don't know what that was. Must have been some sort of news on Veritex. But overall, the volatility is absolutely very, very low in comparison to where it's been in the past and compared to the average right now. So I have a buffer. That's really what I'm doing is I'm creating a buffer against volatility by buying these roughly 40, I'm sorry, not 40, roughly 20 trading days, which is about a month prior to the announcement. That way, if volatility goes up and then drops, I have a couple choices. One, I could exit prior to the earnings announcement because I make profits on the volatility and maybe even some of the gamma and the delta. Or worst case scenario, the volatility drops right back to where I got in. However, prices have moved. I made a lot of profit. I am always exiting these prior to expiration. Yeah, I absolutely am exiting these prior to expiration. That's the reason why I'm buying options that will have at least 30 days left till expiration when I exit the position. So as I said, I made an error on this particular position because I should be out of this already. But I did it for demonstration purposes as a simulated account just to show you what happens because I've gone beyond my point where I wanted to be in. For instance, on this particular option right now, let's go further for the strikes. Actually, I probably need all of them. We're close to it. Here we are, 420. The 420 calls and puts. Don't need to put in the order. But right now, the 420 calls and puts, you can see Vega, non-existent. Delta's 1 because it's so deep in the money, it's acting just like the stock does on the call side. The put is so deep out of the money, and you can see it's got a negative 0.03 delta. So yeah, you got to be out of this before the earnings announcement, not before the expiration, if you're simply playing volatility. Case in point, again, I go back to my chart, and this is on Veritex. No, sorry, this is on AXON. On the day of entry, you can see we're in a strong bullish trend right now at 420. The implied volatility was relatively low. The options selected at that time were not going to expire until January 17th. The earnings announcement was November 7th. So even at the November 7th, you still had December, January, and a couple weeks before the expiration. Was time really going to be a problem? Time decay? No, when you go that far out, as you saw, current options at the money, time decay is an issue. It's at a negative 80 right there. But let me get rid of these. Let's do at the money now. Going out further in time, say we're getting ready to get in and we're going to exit within 30 days, this would still have 44 days left until expiration, right? Well, the theta might go from negative 39. And look at that. Actually, it doesn't even change much, does it? The time decay between 74 days and 38 days is actually better, which is odd. You would expect the theta to go increase a little bit as you get closer to expiration, right? Well, it definitely increases when you go inside of 30 days. This only has 10 days till expiration. So that's why I'm trying to take time and volatility out of the equation with a straddle or strangle and simply play directional movement. Which direction? I don't care, up or down. That's why I'm trying to buy both a call and a put. Again, looking at the theoretical profit and value on the risk profile. There we go. And pan. There we go. Again, if I buy this option with roughly 30 days before the earnings release, the implied volatility should be relatively low. once the earnings come out, it spikes back down or spikes and drops back down. It should be right back where it was. So volatility is not an issue. If I'm buying where I still have at least 30 days till expiration after the announcement, I'm taking time out of the equation. I am simply playing gamma and delta at this point. And that makes it a little bit easier to focus on one Greek by taking the other ones out of the play. So if I were looking at the current options, again, that's why with the filters that we have, we set them up in a certain manner. Actually, it was 25 to 35 days. You can see I've got some slim pickings right now, but I can also increase this and do a list. What do we have here? This is, implied volatility percentage change down, and I could add the filters in there as well. Okay, so this was a radar screen. I'm sorry, not a radar screen, but you can go in here and add in a hot list based on low volatility. So right there, I've got implied volatility that's dropping. Now I have to make sure it's below the average. Just because it's dropping a lot doesn't mean it wasn't dropping from a record high. Okay, we have to be careful there as well. And then I would add in the studies, or the filters, excuse me, one of them being next earnings date. Let's see, number of days is less than, or sorry, greater than actually. I'll do 20. Add in earnings date, number of days. You basically can go back to the previous screen and just copy this. One of the easiest things to do, because if you add in lists, unfortunately, you have to keep redoing the filter on each page. But it's not that hard. I just do it like this. I copy it. I happen to have two monitors. Oh, wrong one. I wanted to move this to the other monitor, not my radar screen. Oh, what happened? I moved the whole window. Okay, no big deal. There we go. And anyway, now I can go to the other page because I can still see it on my other screen right now. And I have less than 35. Add in implied volatility is less than the low percentage. So that way I'm making sure that we have relatively low implied volatility. There's an indicator right here that shows me implied volatility divided by historic volatility, and I want it below the lower alert level to show that we have relatively low implied volatility. We want to make sure that these are liquid options. So I have, let's see, open interest, all options should be greater than 10,000. I actually have already eliminated everything with this one filter right there. The implied volatility, didn't I? Kind of looks that way. There we go. So I still have Phillips Edison, Oaktree, Kimco. And again, I've also want to make sure that my applied volatility is relatively low as well. Let's see, I can do this, add this back in, but change it. Oh, there we go. Implied volatility, RS, is, excuse me, less than 40. And I'm just trying to find relatively low volatility that's getting ready to increase because we have the earnings or some sort of announcement coming up, and buy in when it's low for that opportunity. So here again, I look at this particular security, relatively low price stock. I probably wouldn't want to play this one. I don't know if we're going to get a huge move in price. Sometimes the earnings have a jump. Sometimes they don't have as big of a jump. I'm going to look for something a little better. Thermodix. Again, take a look. And it's got to fit the criteria. It's got to be something that has that pattern over and over and over again, where the earnings cause a huge move in price and in volatility. Although the volatility isn't necessarily as, it's not necessary. It's not as critical. Because remember, if I get in when volatility is low, I'm going to exit when the volatility goes back down. I just need that big price move. So again, if I wanted this SRDX, I would choose that one. And just as I did with the other securities, we're currently at the money. Where are we here? Around $40. So I would simply go to my Option Station Pro, SRDX. And again, I'm not saying to do this because I didn't do all the analysis I would normally do for this security. I'm just trying to show you the steps that you would use to be able to place the trade and monitor the position as well. So SRDX, here's my options chain. I would not choose the 10 days or 45 days. Again, the reason why, time decay. My theta time decay, it doesn't look so bad on the 45s, but the closer you get to expiration, the higher it's going to go, and it can be a pretty good percentage of your premium. This is a relatively low price stock with low premiums, but by going out further, a couple things happen. Volatility or Vega is usually higher on further expirations than it is on nearer expirations. So again, if I'm looking to profit, I can do it in two ways. One, if volatility increases and raises the value of the options I purchased, I can exit prior to the announcement. If I get a decent enough profit, a good return, I can simply exit. Or once the earnings have come out, the news is out, usually there's a big price jump, either up or down. I can exit because the delta will make me profit there, but the volatility will return back to where it was pre-announcement where I entered, and I should be able to still walk away with a profit. The problem is holding on too long. And yeah, this is not something I'm going to trade because that spread is like what, $4, $4.10. No, thank you. That's not good. I'm not trading. Well, even the $40, it's over a dollar spread between the bid and ask. I'm not taking that one. So I want something a little more liquid. That's the other problem. Liquidity. We got to make sure these are decent securities that we can get decent pricing on. So Ken's absolutely right. Huge spread. No, thank you. That's why, I start off with the S&P 500. These are more heavily traded securities that will have the similar patterns that I'm looking for and good pricing, lots of liquidity on the options. Now let's check out Hershey. 30 days left till expiration, 31. And again, looking at Hershey, it has earnings coming up. Does it react? Whoops, wrong one. Does it react with a large move typically from the earnings announcements? Doesn't look it. There is a big trend moving into the announcement and a big increase in volatility, at least on that one. Let's see this one. Let's go back and bring it up on this chart. Here we go. Now you can see a little better. There's my earnings announcement. You can see the big jump in volatility, the big drop in volatility. Again, going from roughly, when was the announcement? 1 month before the announcement would have been November 7th. So October 7th, you can see the volatility went from 21. Wait a minute. It went right back to 21, but it spiked at 29. So not a huge amount. It was 8 points of volatility. Well, if we were to apply that to an at-the-money option right now for Hershey, and I'm not saying that's always going to be the movement. We would have to go back and take a look to see what is the average move leading into earnings. Here, August 1st, July 1st. July 1st was at 22. We hit a high of 44. It was even better. And the price movement was pretty decent there. But let's just see. I'll go one more. Again, earnings announcement, May 3rd, April 3rd, we had 25 and hit 35. So we had 10 points gained. One was 9, one was 10, one was way off. It was much more. So it looks like the average might be about 10, 9 or 10 points. So again, we had earnings on February 8th, and we went to a high of 36. On January 8th, we're at 23, so we gained 13. So we'll call it 10. Let's say we're anticipating a 10% jump in volatility. Okay, well, if we applied that to current price, 166.74, Hershey, 166. We can do 165s or 167.50s, I guess. Probably 165s when we go out further in time. So right here, 130 days left till expiration, 165s. Not bad. I mean, it's a little bit bigger. The spread. The spread is probably wide because it's after hours right now. During regular trading hours, the spreads will be much narrower. But here's the thing. We've got theta time decay of 4 cents. That's nothing. However, we have a vega of 38. So basically, we're looking at a move of 10%, 38 cents per percent, right? So that's $3.80. That's almost, let's say we bought it for 12 bucks. I think that's going to be high. What's the theoretical value? Actually, theoretical value is 14. So we could buy this under value for the call, and the put is pretty much at theoretical value. That's not bad. We're buying at or under value. If that goes up $3.80, it's almost 4 bucks. It's almost 1/3 of your premium in the profit. Theoretically, again, there's no guarantee it's going to do that. But theoretically, if it follows the normal pattern where it goes up by 10% in volatility, even before the announcement, you stand to make almost a 30% rate of return by just buying the right option at the right time. Now, what happens with price movement? Remember, the time decay is going to take some off of that. But again, if we're in for 30 days, 4 cents times 30 days, again, you subtract that from your gain, we're still going to be making about 20-25%. Now, if we take a look at price movement, what is the average price move on this? This would require, of course, both types of positions. If we're playing for the volatility to increase, you exit just before the announcement, whenever you get a spike in volatility, okay, or you start to see it start coming down. You don't want to exit too early. It's very easy to do that, but as close as possible to the day of the announcement, you'll gain the most in the volatility. As far as how much price moves after the earnings, this one did nothing until a few days after. However, if you entered on the 7th, that was 1 month before, your entry would have been around $185 or 190. I probably would have chosen the 190s if possible, because at the time, you're in a bit of a downtrend right here. And if I buy, let's see, where's it here on the 7th? We actually gapped down. You buy the 185s, you're slightly out of the money. If you buy the 190s, you're slightly in the money. You have a slightly higher delta, and gamma is going to increase that delta a little bit faster. So not only are you going to be profiting from the implied volatility gaining, but you're also going to be getting extra from the gamma and the delta as price moves in that trend direction. So in this case, by the time it got to the earnings announcement, even if you exited the day before earnings, let's say you got out in the morning at 175, it had moved down $10, right? Let me see, where's my calculator here? So we had the delta, or sorry, the gamma was, not the gamma, sorry. The vega was 38 cents, and we were in the trade waiting for a 10-point move. So that was $3.80. We also had $1.20 of time decay. So 380 minus 120. Oh, I did that wrong. I can't even type right. 3.8 minus 1.2. I can do this in my head anyway. It's only 2.6. So again, if we make $2.60 just on the volatility and time divided by the $12 for entry, that's a 21% rate of return. That was pretty close. It said between 20-25%. But in addition to that, remember, we had a $10 move in price at, say, roughly, we're probably above 50 on the delta, but let's just call it 50 to make it easy. That would have been another $5, right? $5 in price movement because we saw the trend direction. The calls would have gone up in value. The puts would have gone down in value. Probably wouldn't have been a full $5. It might have been close. But that changes things. Now that's $7.60 a profit. Divided by 12, that's a 63% rate of return on that strategy. Looks pretty nice, doesn't it? Now, one other thing that we can do is if we know approximately what the moves are by looking in the past, we can guesstimate what our potential gain is going to be in the future as well. And not only that, we can also, let's say we'll do this as an example. Let's say we have earnings coming up soon. Obviously, we do in about 31 days on Hershey. If we're going to do the at the money options, we're still pretty much in a downward trend. I have to do a little more analysis to see if it's likely to continue or not. But let's hypothetically, let's say we're expecting this to continue to go down in value. Okay. So we may be looking at the 170s rather than the 165s. That's the choice, right? We look at the 170s versus 165s. Again, we're looking out at May because we'll still have 100 days left until expiration. If we try to do these, the 45 days, what'll happen is this time decay will increase rapidly. Remember, if we get out 30 days from now, there's only going to be 15 days left. May not increase too much, but you can see how they're a lot closer together, the volatility and the time decay. I want to make sure I'm gaining on volatility, not losing on time decay at the same time. So that's why I try to take it out of the equation. I go further out, meaning if I go way out to 130 days, I'll have 100 days left till expiration. I don't have to worry about time decay. It's a small amount. Again, $1.20, right? 4 cents per day, 30 days. $1.20 is 10% I'm giving up in time value, but I'm expecting $3.80 based on volatility. And if we get a 10-point move, let's see, I was looking at the 170s, and we have 48 delta and a 51 delta. Maybe we do want to do this 165. Although that'll go further out of the money quickly, while these will go further in the money quickly. I don't have the gammas on here either, do I? That's okay. I'm not going to worry about it too much. I don't want to get too much into that. But let's say we do the 170s. That would be buying this one, and buying the put at the same time. There it is. So we analyze that position. There we are with the straddle. Max profit, infinite to the upside because it can go up forever, and downside. Well, you can also figure out what day do we wish to exit. Remember, I'm going to be exiting this. See your graph with roughly 100 days until expiration, because that's the earnings days, 31 days from now. And this has 130 days until expiration. So that blue line is really what I'm going to be dealing with. Let me get rid of that green one for now. I don't really need it. Just need the two that I'm working with. Right there. Okay, so that blue line is really what I'm working with. Yellow doesn't really matter. Actually, I probably should switch these because it's easier to see the yellow, isn't it, in the background. And let's put them at the same. 100. Actually, no, I won't. I want to be able to compare them. There we go. So the yellow is the one I'm actually dealing with. And you can see that risk reward profile looks pretty good. Obviously, the more time decays, the deeper this goes, and I need a bigger move. But as of right now, because I'm going very far out in time, I'm kind of paying a deposit that I'll get back when I exit the position. So if I want to put on this position, I simply place it. Let's see, 1935. It won't place right now. I'd have to place it for the morning. But let me go ahead and trade. And I don't know exactly how much it would be. I'm just going to do a market order at the open tomorrow, GTC. And we'll come back and reevaluate this, see what happens several days or several weeks from now. There we go. Nope. Why was it rejected? I'll have to check that later. I'll put it in tomorrow morning. I'll make myself a note. Anyway, we further analyze this. Like I said before, we're expecting volatility to increase. Currently, let's see. There's my break-even points right there. And about right there. So we can see what happens, obviously, as time goes on. This will be my curve. That's the day I'm expecting to exit just as earnings are being released. If volatility does go up by that 10% I'm expecting, let's see what happens. Did that go? There it goes. Oops. You can see that based on that move, remember when I went to 0 for the volatility, this is not having any price movement at all. This is pretty much break even, isn't it? There we go. Get it almost exact. So this is kind of what I'm demonstrating here. If I'm doing this now while the volatility is relatively low and Hershey on average gains roughly 10% in volatility before the earnings release, if it does do that, even without any price movement, we're looking at either a $588 gain if we drop, or if we rise, $668. That's before the move and before the earnings actually come out, just simply playing the volatility. Now, there's no guarantee it's going to do that, right? But that was at my break even point, just going up even a little bit. Or what if it doesn't move anywhere? If it doesn't move anywhere, this is the current price last. That's still a gain of 461.55. That's why it's very important to make sure you buy with low volatility. And if you're worried about time decay overcoming that, you buy enough time to take the time out of the equation for the most part. Now, if prices do move, which are likely to do, again, right now we're at 166. The average move was roughly, what was it, 10 points, I think? No, it was, I forgot what it was now in Hershey. I've been looking at so many different securities and different moves. I don't know if I actually looked at the percent, or I don't know, it wasn't much of a price move. The price move was before the earnings came out in the trend. Yeah, when the earnings come out, it doesn't really gap much. So this is definitely going to be something that I probably want to exit prior to the announcement. Why? Because I'll have all my profit built in already. Right here, before the announcement, look at my volatility. It's at a spike. And we've already moved a bunch in price. There's nothing to be gained by holding into the earnings because it typically does not gap. That is very different than the other security we were just looking at. That's why I got to know your securities. AXON typically does a big jump. That way, volatility goes right back to where it was. I don't make anything on the volatility. I make it all on the price move, the delta. Okay. It doesn't work on real positions, only on simulated? Oh, okay. And I wasn't aware of that. Should work the same on both. But it should be about the same anyway, the theoretical move. If you do it in a simulated and then place your trade, it should react almost the same way. Anyway. Again, this one, same thing. Price jump is the price jump potentially will make you more based on the past moves, the average jump. You can multiply that by the delta to see what you theoretically might profit. If that is potentially more than what you could possibly gain on the average move of volatility, then you wait for the news to come out. If not, simply play the volatility and exit there. Now, what is the big difference between this strategy and the strangle? Well, the strangle is going to be cheaper to get in. This strangle was on SMAR. So let's go to that position, take a look. Go back to my manage. Unfortunately, this one is not a winning position. They're not all winners. So we'll analyze duplicate here. Here we are, strangle. And with this one, you can see, or maybe you can, if I zoom in more, you might see it better. I used two different strikes. Went long on the 60, there it is, 60 call, 55 put. So what happens is our break-even points are going to be widened out. It'll cost less, so therefore the maximum loss is less. Okay. And of course, with time value, there's still time left, typically when I do these. Once again, if I'm going to put on the straddle versus the strangle, let's go back to the same one I was looking at, the Hershey, HSY, and just compare the two. It'll be easier. So again, with Hershey, I was looking at the straddle, 170 straddle, and taking a look at what happens with the volatility change. Let's go back to where we were. The base is here. Current price, break even upside, break even downside. If we slightly change this, so that way we do a call, and let's see, we want to do the call. I have what now? The 170s. So maybe we'll do 175s. Just move it by 5 points. And the put will move down to custom. See if it changes. 165. There we go. It shows us custom, but this is the strangle. The only thing I did is changed my legs so that way I'm not using the same strike. As a matter of fact, can I compare this? No, I have to do it separately. But basically what I'm doing is it's going to cost less. I forgot to show you exactly what the price was. Let me go back again to the 170 and whoops, 170, 170, and we're at 1935. Let's write that down. If I can find where to put my pen. Okay. So instead, actually, I can keep that. Do this trade. It's blank. Good. Go back to options. And again, put in buy the 165 put, buy the 175 call, analyze. And there we go. Now I've got them side by side. So this is now the strangle. Notice the price difference. It's only 1510 versus 1935. So my max loss is lower. The problem with that, yeah, it's cheaper to get in, but I'm going to need a much bigger move one direction or the other for profit to potentially happen. Before my break even on the upside, let's see, again, if we get that volatility change, 10%, it actually wasn't that bad off. Before, on the straddle, we have 668 and 588. Again, this is assuming we get the full 10% move, which is no guarantee. But historically, that's what's happened. And the strangle now, the same numbers. First of all, the break evens would probably be different. First of all, if I take it without the 10% to where we are currently, it's slightly different. As you can see, this is actually a low losing position. So my break evens are going to be further out. Where's that break even? Come on. There we go. This one's much further, the call side. There we go. So just using those break-even prices, now if we get a 10% gain there, 662, it's almost the same. 578 versus 588. It's only $10 difference. But they're further out. And if I kept them at the same price, that's probably what I should have done, is compared apples to apples by keeping them at the same price. So let's go back and do that. Or actually, I'll do it this way now. Instead of the strangle going up 10%, staying where I was with the break-even price on the strangle, making 662 on the upside, this actually makes 678 a little bit more. And 593 versus 578. So price-wise, which one's better to place? Let's see. 593 minus 578. It's a $15 difference on one side. Or on the other side, potentially, $16. Either way, it's about $15 difference in profit. The cost difference, though, is $400 cheaper. So is it worth giving up $15 in profit to, you have to spend $400 more to get in the position? It may be better to put on the strangle based on the volatility movement. Okay. Yeah, you'll get, I'm not sure if you guys send out links, But yes, this is all recorded and you'll be able to come back to this. Basically, all I'm doing is trying to compare whether or not it's better to do the straddle or the strangle on this position based on how much profit and how much price movement I'm likely to expect. Now, if I can do this based on the price move, I did it based on volatility. Because a lot of times when I put on this position, again, I'm looking to get into this position because volatility is relatively low at the entry of the position. This is the position we were just analyzing. And volatility went all the way up and spiked. And this is on the AXON, dropped. Let's see where it is right now. That's still in a winning position. 8,700 profit currently, but this would have been up a whole lot more if I had exited back here when the prices moved up, because the price is pretty much right where it was after the earnings announcement, and I would have had more volatility gained. So basically, in order to place that position, again, I just look for an opportunity. And we'll come back and go back to reevaluate this again in our next session, kind of take a step back and look at it and compare the two again, answer any questions you may have. No, this volatility indicator is actually part of TradeStation. It is the indicator. And if there's any questions, go ahead and ask them now because we're going to wrap this up. But when you go into studies, add study, it is a built-in indicator right here, implied volatility, all options right there. That's the one I'm using. And of course, if you want the full workspace that I'm using to find the opportunities, either for straddles for earnings or strangles, those are available to you for free. You can download them at the Options Education Center. So right here, you go out to TradeStation.com, learn Options Education. And if I scroll down, once it loads up, you'll see the very first one, if you scroll all the way to the right, see, Strangle shows up on the homepage there, but if you keep going to the far right, there it is, straddle opportunities for earnings. You click on it. There's an article and a video on the strategy itself. And there's a downloadable workspace. So all those tools and the filters are already put together for you to start practicing with that. Okay.
An options replay would be on the prior page, right under the articles. That's where you link to the archives.
Oh, right. Thank you for bringing that up, Jesus. I forgot about that. Yes, if you go back to the Options Education Center, again, under Learn, Options Education, and scroll down a little further. I think
No, you
they're
went
here.
too far. You went too far.
I went too far.
Yes. Just keep on going. It's right above the webinars.
Oh, there it is. Sorry.
Yeah.
Yeah, I went too far. Okay. Yeah. So this is where you have the pictures of all the strategies I've been showing you. Just underneath that right here, you have options replay and you can watch the previous sessions. That's where you'll find this one as well.
All right. Any other last minute questions that you see, Brandon?
Yeah, if you're wanting to learn the spreads, this is where you learn them right here. You can go into, like I said, under Learn, Options Education on TradeStation.com. And that's where you start learning those strategies. And the very first one I mentioned, Straddle, well, Strangle's there, but Straddle is the very first one. If you go all the way to the right, and we're going to be creating some different ways of sorting through these pretty soon as well. But you can see right there, Straddle opportunities for earnings, the workspace, I'm sorry, the options replay. This webinar will be recorded and put here as well. So you can go back and watch this over and over again. And inside, like I said, there is a webinar on the strategy that teaches you about the strategy itself, as well as the workspace is downloadable. And there's an article you can go through as well. So plenty of information for you to help you learn those.
Yeah, that's a lot of information. Well, hey, Brandon, thank you so much for joining us today. Again, I'm sure that our attendees will appreciate the recording to play back all that useful information. Everyone, thank you also for your time. Thank you for being here. We do options replay every 2 weeks. The next one will be 2 weeks from today. I'm not sure what that date is, but please check out the calendar of events. We post all the events there, and anytime that you want to see what's happening at TradeStation, just check the events and you'll see everything there. Brandon, again, thank you for your time. Everyone, wonderful afternoon, and I'll see you next time. Thank you for being here. Bye-bye.